Today, we will be talking about some of the best dividend stocks to own long term for your portfolio. Now, this might be different than a lot of other YouTube videos you might watch where they recommend stocks that have a very high starting yield, but then the chances of that stock raising its dividend or appreciating in terms of the actual capital are quite slim. So, these might be some stock picks that you would not think of as great dividend stocks, but hopefully I can change your mind. And as always, be sure to like, comment, and subscribe. It really helps a growing channel like mine continue to grow. So there's mainly two different types of dividend investors. There's those who invest for higher yields right away, and then there's those that wait patiently for those lower dividend payouts, which may eventually get larger over time, as well as there's a higher chance of capital appreciation. So let's go over the higher dividend characteristics first. So they have a higher dividend yield and there's little growth. The actual stock price usually doesn't change much. It doesn't really go down or up over time. It's already currently profitable, so there isn't really anything in terms of the company, doing something that's really dramatic or changing or innovative. It's already profitable. It's already been around for a long time, and it's just paying out those dividends. And it's often undervalued because investors, they're not looking for that future growth. They already see the growth there, and that's being priced into the stock. There's a lower price to earnings ratio and lower price to book ratio as well. On the other hand, dividend growth, it often has a very lower dividend yield. Most of the stocks that I look into are around the 2% range, which might be a lot lower than the higher dividend investors who usually want something at least 4% or higher. And there's also a good chance of future potential, meaning the stock is not, or company is not done fully developing. They often have more innovative products on the side in the future. And they're often overvalued because it's very hard to price in what a future value of the stock could be. And that's already being put into the price. So you want to kind of find those undervalued dividend growth stocks as well. They often have high PE ratios and high price to book ratios. Now, as you can see on this chart here, so let's say a stock was giving a 10% yield and it continued to remain like that for the next 20 years. As you can see, you'll always get a 10% yield, which is very good. Definitely not something to complain about. But the chances of that being raised in the future are very slim since the company is giving out all those earnings in terms of an actual dividend, while the smaller company is paying a very small dividend yield at first, but it's being able to continue to reinvest into the company and therefore is able to raise its dividend throughout the years. So as you can see, eventually the dividend growth company will reach the stagnant dividend company at around the 15-year mark, and then will continue to have a higher yield on cost as time progresses. So the first stock we're going to talk about today is the Home Depot. I'm sure most of you have heard of this company before. Have either been there, maybe you were fixing up your house and needed some supplies from Home Depot. Now this stock currently gives about a 2.6 yield, which you would be surprised that I'd be recommending it. But the key here is patience, and as you can see, they've raised their dividend quite substantially. I will show more of that in the next slide, but here let's talk about why Home Depot is a good stock. I actually don't own either of the two stocks that I'm going to be recommending, but I do eventually plan on buying them. And Home Depot had a record year in 2018. It set new records in total sales and as well as earnings per share. The company posted total revenues of $108.2 billion, which is a 7.2% year-over-year growth. And then their earnings per share of 9.73 was a 33.5% year-over-year growth. So very good 2018 year for them. And then Home Depot has also approved by its management share buyback in the amount of $15 billion. So if you're into share buybacks, Home Depot will be doing a lot of those in the future. And it's successfully bought back shares to reduce its outstanding share count by more than 16% over the last 5 years, which is pretty crazy. And then Home Depot has also raised its dividend 32% in the last year. That is a huge increase. and it has also increased its dividend each of the last 8 years by an average of 24%. So now you can maybe tell why I'm recommending this stock as a dividend growth. It just continues to raise its dividend quite substantially. And then I also like Home Depot because it seems to be sort of recession proof, something that you might always need in the future because construction projects will always happen. People will always be building new things, remodeling, and it seems like people like to see materials in person. And this is kind of a hard thing to maybe judge if you're online, but online sales are also picking up too for Home Depot. And as you can see, in terms of the actual earnings, Home Depot had about $10 billion in sales or net income last year, and it has consistently beat its earnings reports. Now, this is where the real magic actually happens in terms of yield on cost and dividend growth investing. So here I took how much Home Depot was worth on April 18th, which is today, the day I'm recording this video, of 2011. It was only worth $37.76. That year, it paid out a quarterly share of 25 cents, which for a full year comes out to be $1, and that gives you a yield of 2.6. And then in 2019, as of today, it costs $206.81 per share. The dividend per year is 5.44, which coincidentally happens to still be a 2.6 yield. So you might be thinking, wow, in the last 8 years, the yield hasn't changed. Well, here's the key difference. For the yield on cost, you will only take the amount that you originally bought the stock for. So the original buying price, if you bought it in 2011, was 37.76, and now the dividend paid in 2019 is 5.44. So for a yield on cost, we would take the original, or we would take the dividend paid and then divide it by the original, which gives us an amazing yield on cost of 14.4%, which is an amazing return. Basically, every year you're almost guaranteed, unless the company for some reason cuts its dividend, a 14% return, which is great since the average S&P 500 return is about 7%. That's a 447% capital appreciation, up $169. Imagine if you owned a lot of shares of Home Depot back in 2011, you would be quite rich right now. And here is 2.63% dividend yield, 5.44 every year, and then Home Depot is only paying out 56% of its earnings to shareholders, which means it has lots of room to continue to grow that dividend in the future, which it's had double-digit increases each of the last 8 years, and as well as improve its business. So definitely room for capital appreciation as well. The second stock we're going to talk about today is McDonald's. Obviously, you have all heard of that. If you live in the US or really anywhere around the world, you've seen the Golden Arches before. Now, they've had a huge boost in the sales from all-day breakfast. They've also added a lot of healthier menu items because more and more millennials seem to be somewhat more conscious about what they're putting into their bodies. And McDonald's has exceeded analyst earnings per share estimates for the 14 of the last 15 quarters, which is pretty great there. And McDonald's, if you've ever seen the movie that recently came out about them, they're somewhat of more of a real estate company in addition to being a fast food company. So they own $30 billion worth of real estate assets. A lot of the franchisees, McDonald's requires them to buy, or McDonald's will buy the land and then they will make the franchisees operate on that land. So they're kind of collecting royalty in terms of real estate. And as you can see on this little graph here, on the last 5 years, this was taken straight from McDonald's 10K. If you invested $100 in McDonald's versus the S&P and Dow in 2013, you would have substantially more money in the past 5 years had you kept your money just in McDonald's versus the S&P 500 and Dow Jones there. McDonald's also kind of has a very large brand loyalty. I'm sure if you saw a lot of fast food chains and you really like McDonald's, I think you would continue to shop there. Or if you were somewhere as a tourist and you saw McDonald's versus something you never heard of, you would kind of go to McDonald's just because you know what to expect there. They have very cheap prices, which makes it accessible to a lot of lower income families. And then people obviously will still need to eat even in a recession. That's why I like McDonald's. But let's get back into our yield on cost here. So McDonald's in 2011 of April 18th was trading for $76.91. It gave out a dividend, a yearly dividend of $2.44, which came out to be 3.1% yield back in 2011. 2019, the now trades for $194 a share. Dividend Yearly dividend of $4.64, which comes out to a 2.3% yield, which is lower than what it was trading at in 2011. But for a yield on cost, we would take the original amount that we bought in 2011, and then the dividend that is now paid in 2019 gives us a yield on cost of 6%, which is not too bad. The reason why it's a lot lower than Home Depot is because McDonald's has not been raising it double digits every year. It has instead, for the most part, increased it around 8%, but this last year they increased their dividend by 15%, so maybe that's a sign of things to come. They have a very good balance sheet. As you can see here, their payout ratio is only 60%, and then probably the most important part is right here is the dividend growth. They've been raising that dividend for almost 50 years, which would make them a dividend king. Right now they're at 42 years. So that's what you definitely like to see in a company, that shows that they know how to manage money, that they have smart management, and they're being responsible to their shareholders. So hopefully I was able to show you why investing in the higher yielding dividend stocks isn't always the greatest of ideas, and sometimes the smaller starting yield companies can eventually pay off more in the long run, because they will eventually raise their dividend, as well as the capital appreciation you might not get in a higher yielding dividend stock, like such as a utilities company. And of course, this strategy isn't for everyone. Always do what's best for you. Here are two memes to enjoy there, but if you guys could really like, comment, and subscribe. I don't know if you guys want to see more videos like this. I only did 2 stocks. I definitely have a lot more that I want to talk about, so be sure to tell me what you want to see and subscribe. Thanks, guys.